Hello, very good afternoon to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here, and just a quick reminder for the month of February, we will be starting Daily Dose at a slightly different time at 1 p.m. So before we start today's gist of today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a quick recap what has taken shape yesterday in terms of the intraday performance across the major cross-asset classes, news flow, relevant economic data release, and thereafter I'll cover a particular intermarket dynamics more pertaining to the US stock market. And lastly, we'll touch on our usual intraday daily technical outlook on the major cross-asset classes. So yesterday's we call it, and in fact, not even yesterday, in fact, for this entire week, will be the so-called the forefront of this ongoing trade tension on the global scale between US and its major trading partners. So what has happened, taken shape yesterday, was very interestingly, we start to see a pullback of Trump hawkish rhetoric, where Canada, give me a minute, okay, where both Canada and Mexico trade tariffs that is being imposed by US will be delayed by a month after both leaders managed to adhere to Trump requests from here. So that also causes a relief in the FX market, where we start to see the dollar strength setback yesterday, and that also came in within our expectation. Why? Because we were actually looking for a what you call it, a much more neutral view between the euro dollar, and we also expect the Aussie dollar to shape a mean reversion rebound, which it did, and the dollar yen continues to yo-yo within its said sideways range, but managed to cap below the 20-day moving average. And because of this, a dowback of this US trade tariffs against Canada and Mexico by a month, the S&P 500, the Nasdaq 100, and the Dow Jones, and as well as the Russell 2000 managed to recover from the low of the intraday session yesterday. So at the start of the intraday session, they plunges. Then thereafter, it managed to trade higher and close near the session high. That is being seen on the Nasdaq 100, the Dow Jones as well, right over here. So that kind of created a positive feedback loop on the intraday basis on the major US stock indices. And also yesterday in our intraday technical outlook, we do expect a potential minor mean reversion rebound on the Nasdaq and the Wall Street index, pardon me, which is the Wall Street 30 representing the Dow Jones Industrial Average. So both of these two major US indices that we cover on the daily basis for our short-term intraday technical outlook, both has rallied and hit the expected mean reversion resistance level. So what happened next? Later I'll touch on more. All right, from there. So other particular news flow over here is more pertaining to China. So we know that China is one of the major trading partners of US, and also China in terms of global economic clout, in terms of the ranking of PP based on purchase PPI or purchase power parity. China is ranked number 2 in terms of economic, we call it status, below US. And what's interesting over here is that for Trump, he decided to only impose 10% tariffs on China. But yesterday, because there are no negotiation between China leaders and Trump, so Trump didn't actually hold back China tariffs, which is actually due to be imposed right now as we are speaking. So let me refresh the news over here, because the US is actually scheduled to impose 10% tariffs on China from today onwards. All right, so it seems to me that blah blah blah, we have now passed the deadline for US imposing 10% tariffs on Chinese goods coming into the country. So it seems to me that nothing is out yet, but what seems to be, there's actually a kind of a undisclosed source, as reported by various media outlets, stating that Trump will speak with Beijing this week. That means, i.e., there could be a potential phone call between President Trump and Chinese President Xi in this coming week to discuss about some form of negotiation on this impending 10% tariffs that are going to be hit on China, which is by right it should take into effect now. Okay, as we are speaking, because so far, oh yeah, I think there's some reiteration going on again. So it seems to us that the deadline has passed. They didn't actually manage to delay the 10% tariffs, US 10% tariffs on China, and now China starts to hit back based on this Bloomberg Live news feed, saying that China to impose 50% tariffs on coal, LNG imported from US, and also China to levy some tax on some products imported from US. So it seems to be there's some tit for tat measures between US and China that is taking place right now as we are speaking. So later I'll touch on more about its impact or the intraday technical outlook on the various cross asset classes. All right. So okay, Australia and New Zealand extend losses to 0.7 on trade tension. So we know that the Australian currency is very much we call it synchronized with the China growth aspect. So we know that for sure, tit for tat measure between US and China doesn't gel well for Chinese growth prospect as well, with the another potential signs of one way China could actually elevate a US 10% tariff is to devalue the Chinese yuan. Once the Chinese yuan is being devalued, they will have lesser purchasing power to actually import Australia iron ore, which is China, we call it main exports from Australia, one of the key export from Australia. That could also have that actually explain the negative feedback loop on the Aussie dollar. And we know that the Aussie dollar has a direct correlation with the Kiwi dollar. So once Aussie dollar fall, the Kiwi dollar may also fall in direct correlation as well. So later I'll touch on more about that on the Aussie dollar based on this news flow over here. All right. So one that's what has taken shape right now in terms of the trade tension that we are speaking. And also another thing to look out for yesterday was news flow was pertaining to OPEC. So OPEC yesterday maintained its stance, regardless of what is going on in the global trade tension rhetoric right now that is spilling out in the global markets. So what OPEC Plus did over here is that they stick to the policy, and what mean that they are solely scheduled to unwind output cuts gradually from April. That means from April onwards, they will slowly increase their production, despite the fact that this ongoing trade tension may lead to potential lower economic growth globally. So that also explain after this news, the WTI could actually decline pretty much significantly. So if you look at the performance of the WTI crude yesterday, it actually shaped this bearish engulfing candlestick. So they're actually down by -2% yesterday on the particular OPEC Plus announcement to maintaining its gradually, we call it a supply cut unwinding, the unwinding of output cuts. That means they will slowly increase oil supply from the OPEC Plus region gradually from April, and coupled with trade tension that could potentially be detrimental to global economic growth, that actually explain the slide in the West Texas crude oil yesterday. And technically, what's important that the slide actually took shape right exactly at our resistance level, which is the 20-day and the 200-day moving average, where we flipped to a intraday bearish stance in our West Texas crude oil outlook yesterday. So do stay tuned for what is the latest intraday technical outlook for West Texas crude oil when I cover that in my intraday technical outlook segment. So now that's for the news flow and economic events releases that is pretty much important that I want to share with you of that took shape yesterday and a while ago. Okay, based on the latest trade tit for tat measures coming up from China. So now what's next over here will be the intermarket dynamics I'm going to share with you all. So this intermarket dynamics more pertaining to the performance of the Russell against the Nasdaq and the Dow Jones against the Nasdaq 100. As we know that Nasdaq 100 is one of very high beta US indices, more pertaining to risk off, risk on effect in terms of how it is. Actually, what is there as Nasdaq 100 is considered as a growth proxy. All right, we know that growth proxy, anything that is pretty much very vibrant, market is very risk on. This growth proxy will outperform. All right, if market starts to be pessimistic about the state of the global economic affairs, that what we are seeing right now, this Nasdaq 100 will underperform. And do not forget over here is that Nasdaq 100 in the last 2 years has been riding on the coattails of this AI productivity driven growth team play centered on NVIDIA, which is considered as a premium GPU chip to run AI models. That means, i.e., any corporation or company wants to run a higher end AI models to improve their productivity, got to actually purchase NVIDIA GPU semiconductor chips. And if you don't want NVIDIA, we have other lower tier like AMD, which is one of them. All right. But however, last week we have another competitor out from China, which is also ironically the ongoing US China trade war, tech war narrative, that US wanted to actually prevent China from getting this higher end technology know-how, especially in the AI space in the last 2 years. But DeepSeek managed to actually surpass this we call it restriction that US imposed on China, and managed to actually come up with a rather similar capability of function with OpenAI. So OpenAI uses NVIDIA chip to run its AI model, ChatGPT. So DeepSeek itself is very similar to ChatGPT, but managed to have a operate at a fraction of OpenAI $1 billion cost. So in terms of DeepSeek is really dependable. They only run it at an operational cost of about 5 to 6 million. So that actually explained the Nasdaq 100 underperformance the last 2 weeks against the Dow Jones Industrial Average. But primarily from a technical analysis perspective, we will start to see the ratio of the Dow Jones Industrial Average divided by Nasdaq, the downside momentum will start to ease by shaping this bullish divergence. Very similar to the ratio of the Russell 2000 versus the Nasdaq 20-day rolling momentum has also eased as well by shaping this bullish divergence. And we will start to see a higher low by these two ratio. That means, i.e., the Russell 2000 and the Dow Jones Industrial Average seems to be getting we call it potentially starts to actually ease their previous underperformance against the Nasdaq 100. And if they starts to break above this level over here, there's this very clear resistance level. Okay, if it start to break out above this resistance level, okay, this level here, this little red line, then potentially we start to see a higher high with a higher low. That means we start to see the onset of a potential multi-week, and potentially it could last for multi-month Dow Jones outperformance and Russell 2000 outperformance against the Nasdaq 100. All right, so something to actually take a look out for as well. All right, so this is the intermarket dynamics that is actually shaping up in the US stock market from a medium term perspective, right, that I like to share with you guys. All right, so with that, now let me touch on the intraday technical outlook on the FX market over here. So let me expand my screen so that you guys could see. All right, so given the latest news flow just a while ago due to the tick for tat measures up from China, because the deadline has already passed, so US was to proceed to impose that 10% tariffs on China, and China hit back with some tariffs as well. Let's see how the FX market actually perform. So what we could see over here is that the dollar yesterday, it managed to actually did that pullback and close below the 20-day moving average, and right now it managed to actually shape that bullish candlestick. Okay, after that news flow that is impacting the FX market, that means dollar strength seems to be coming back into the picture again as well. So with that, let us take a look at the euro dollar that we cover on a daily basis over here. So for the euro dollar over here, yesterday we were neutral. Okay, we were neutral over here. So given the fact that there's this bearish reaction of this first resistance level that we covered yesterday, after it broke above the neutrality limit, it hit the second the resistance after the upper neutrality limit at 1.0345. So this is also the 20-day moving average over here. So what we could see over here is that the hourly RSI also has been pretty much bearish as well. There's this bearish reaction of here at its parallel resistance. And what we are seeing right now, it managed to broke a key parallel support as well, and deep down below the 50 level mark, and hasn't hit the oversold level yet. So we've started bearish, we call it a short-term momentum as being depicted by the hourly RSI. We will flip to a intraday bearish bias for today on the euro dollar using 1.0345 as my short-term pivotal resistance for today. So this will be my ST pivot. Okay, using 1.0345 as my short-term pivot. First support level to watch right now, which is testing at 1.0270. A breakdown below 1.2070 potentially exposes 1.02 figures slash 1.019. So this is a medium term a pivotal support zone. Why? Because of this medium term swing low area or 13th of January that is still holding up rather firm, all right, over here at this point in time. So maximum, this is the support level that we are looking at on the intraday basis, 1.0220, 1.02 slash 1.019. Only an hourly close and a push up above 1.0345 will invalidate today's intraday bearish bias to see a continuation of that mean reversion rebound to revisit the 50-day moving average, confluencing with the next intermediate resistance zone at 1.0440 slash 1.0460. All right, so flipping to a intraday bearish bias stance for today using 1.0345 short-term pivotal resistance on the euro dollar. Now, turning our attention will be the sterling dollar. So the sterling dollar did a squeeze up yesterday and broke above the 20-day moving average. And what you could see right now over here is also attempting to actually shape that bearish reaction of right below the 50-day moving average, and as well as this minor descending trend line linking from the high of 27th of January 2025 over here. Okay, stage a bearish reaction. Okay, so with that over here is that I will flip to a intraday bearish bias for today, given this bearish reaction of this descending trend line and also right below the 50-day moving average, and as well as the hourly RSI has also starts to break down from its parallel support level, and now it's almost showing signs of dipping down below the 50 level mark as hasn't it yet hit the oversold region. So with that, I'll be using this zone over here rather than this. So this will be my first resistance level to watch. Okay, this descending trend line, but I don't want to put it so tight just in case of any whipsaw. We know that this particular trade tension situation is all very much depending on latest news flow that could actually create much more vulgarization in the market. So I'll be using a higher level, which is 125 figure level, 125.20. So this will be my short-term pivotal support zone on the sterling dollar for today. Short-term pivotal resistance zone, pardon me, not support zone. All right, short-term pivotal resistance zone on the sterling dollar for today. We will flip to a intraday. We will have an intraday bearish bias with a first support level to watch, which is the 20-day moving average that was taken out yesterday, also parallel to this graphical congestion area here at 1.2330. A breakdown below 1.2320 exposes 1.24 figure level, which is correspond to yesterday minor swing low, and as well as this congestion area here of 17th of January and 21st of January 2025. However, if we start to say hourly close above 1.2520 short-term pivotal resistance with an hourly close and a breakout above it, that would invalidate today's intraday bearish bias stance to see another round of a mean reversion rebound scenario taking hold on the sterling dollar, exposing the next intermediate resistance level at this 1.2576 zone. Okay, so in fact this is a zone. Okay, 1.25. Okay, let me put it in writing. 1.2580 slash 2610. Okay, so 1.2580 slash 2610 if 1.2520 short-term pivotal resistance upper limit zone is being taken out on the upside. So net in a nutshell, we will have a intraday bearish bias on the sterling dollar due to its bearish momentum reading that has seen on the hourly RSI and the bearish reaction of this descending trend line, minor descending trend line from the high of 27th of January and right below the downward sloping 50-day moving average. We will have a potential bearish bias stance on the intraday basis on the sterling dollar as long as 1.25 figure slash 1.2520 short-term pivotal resistance holds on the sterling dollar. And two key intraday support level to watch will be 1.2330 followed by 1.2240 next. All right, so up next will be the Asia Pacific currency against the dollar, starting with the Aussie dollar. So the Aussie dollar yesterday rallied and hit our short-term mean reversion resistance level, which is at around the 1.6220, 1.6230 level, which is also the 20-day moving average that is acting as a resistance level as well. So with that, we given the bearish reaction of the hourly RSI as well, where the hourly RSI starts to break down below a parallel support and dip down below the 50 level. So with this bearish momentum reading in the hourly RSI, we will still maintain that intraday bearish bias on the Aussie dollar over here. So let me put this as a first support level to watch. Okay, so the pivotal resistance level to watch will be this level over here, okay, which is this minor swing low. Okay, so it's a bit like a zone. Just in case any potential whipsaw, close to the 20-day moving average, minor swing high of 31st of January, and as well as the pullback resistance line of this former minor trend line support that is formerly was in place since 13th of Jan, minor swing low, now turned into a pullback resistance at 62.80. So it will be a zone of 62.50 slash 62.80. Okay, so this will be my short-term pivotal zone. Right, so as long as this 62.50 slash 62.80 managed to hold, we will flip to a intraday bearish bias stance on the Aussie dollar. Two key intraday support level to watch will be 61.65. Below it exposes yesterday minus swing low at 60.90, and if 60.90 doesn't hold, potentially it may slide further towards 60.55 slash 60.30. So this level, if you go back over here, is actually is a Fibo extension level as well, and if you go all the way back, is actually the congestion area. Let me go to the daily time frame chart so that you guys could see. Yeah, it's the congestion area of 9th of April 2020. Okay, low. Okay, so now back to the hourly time frame over here. All right, so if we start to see the price action starts to have a U-turn again, right above 61.65 and surpass above 62.80, then potentially we may see a squeeze up for the extension of a potential mean reversion rebound, heading potentially into the 63.30 medium term pivotal resistance that I highlighted. All right, so net overall, in a nutshell, flip to a intraday bearish bias because of the bearish momentum reading that's been seen on the hourly RSI, using 62.50 slash 62.80 as my short-term pivotal resistance level. Two key intraday support level to watch in first step, 61.65 followed by 60.90 next. So that's for the Aussie dollar. So lastly, turning our attention now will be the dollar yen. So no change on the dollar yen as it continues to trap between the minor swing low of last Thursday and the previous last Monday at 153.70, and still can't break above the downward sloping 20-day moving average, which is which we have our pivotal resistance zone yesterday at 156.50 slash 156.80. So still maintaining that intraday bearish bias within this zone over here, using 156.50 slash 80 short-term pivotal resistance zone, maintaining the intraday bearish bias within this kind of minor sideways range configuration. Lower limit of the sideways range will be at 153.70. A breakdown below it exposes the 200-day moving average, which confluence with the next graphical support congestion zone of 12th of December last year, 18th of December last year at 153.20 slash 152.19. Only an hourly close above 156.80 short-term pivotal resistance zone upper limit will invalidate today's intraday bearish bias to see a squeeze up towards the next intermediate resistance coming in at 157.70, 158.20, which is the lower limit of our medium-term pivotal resistance zone. So net overall, in a nutshell, still maintaining that intraday bearish bias within this choppy sideways range configuration, using 156.50 slash 80 as my short-term pivotal support. It's a short-term pivotal resistance. I repeat again, still maintaining that intraday bearish bias within this complex choppy sideways range configuration on the dollar yen, using 156.50 slash 80 short-term pivotal resistance zone. All right, so that's for the FX market intraday technical outlook. Now, shifting our attention, next will be the major stock indices, starting with the Hong Kong 33 over here. So the Hong Kong 33 continues to hold rather well over here, despite the fact that there's this tick for tat measures coming out from China. So since that it managed to hold pretty well over here, there is also no signs of a bearish divergence on the hourly RSI. Right, no bearish divergence. And the market rally as expected, hit our first resistance yesterday at 2084 before that pullback take shape over here. And in fact, right now there's some form of support that is being formed when we saw this potential so-called hammer-like hourly candlestick after the price action dip close to the 20,170 short-term pivotal support level that we highlighted yesterday, which is also the lower limit of this minor ascending channel that is in place since 13th of January. So no change, still using 20,170. That's indeed a key pivotal support level, given that price action almost managed to hit this level and it managed to stage a bounce of it as well. So from here, what we could see over here is that we will still maintain that intraday so-called intraday bullish bias on the Hong Kong 33 using 20,170 as my short-term pivotal support level. First resistance level to watch for sure will be 20,840. That was being rejected in today's early Asia session. Above it potentially sees 21,320 / 21,390 being defined by three different aspects technically. The upper limit of this minor ascending channel, the one-time Fibo extension from the low of 13th of January, and as well as graphically the former minus the current swing high area of 8th of November that got rejected, and as well as 10th of December. Okay, so it's pretty key interesting level to watch. So a breakout of this level potentially may see further much more substantial bullish momentum taking shape, given that we have three different kind of technical we call it a definition that that actually align or confluence with this 21,320 / 21,390 resistance level. Only an hourly close below 20,170 invalidate today's intraday bearish bullish bias. By the way, hourly close and the breakdown below 20,170 invalidate today's intraday bullish bias to kickstart a kind of a minor a corrective decline scenario unfolding. In first step, retesting the 20-day and the 50-day moving average, all confluencing with a graphical support level at 19,685. Only a breakdown below 19,685 may see a further potential minor corrective slide to revisit 19,350. All right, so in a nutshell, still maintaining that bullish bias, given the fact that yes, negative news flow, but price action is just still shaping that positive momentum that is taking shape right exactly at the 20,170 predefined short-term pivotal support that we have yesterday on the Hong Kong 33, i.e. the Hang Seng Index. So now turning our attention next will be the Nikkei 225. So the Nikkei 225 rebounded as expected, hit our resistance level, which is close to the 20-day and the 50-day moving average around the 39,200 level to the 39,250 level that we have yesterday. And right now we will flip to a intraday bearish bias. Price action nicely rejected off the 20 and the 50-day moving average, and as well as the gap up over here. So using the gap up resistance upper limit and the correspond to the 20-day moving average, acting as a near-term resistance as well. 39,310 short-term pivotal resistance level as well. Hourly RSI also has turned rather bearish in terms of momentum by breaking down below a parallel ascending trend line support. Dip below the 50 level, hasn't hit the oversold level yet. And given the fact that it's being supported by this hourly bearish momentum on the hourly RSI, we will flip to an intraday bearish bias on the Japan 225, representing the Nikkei 225, using 39,310 as my short-term pivotal resistance level. Next support level to watch right now that is testing the first support, 38,150. A breakdown below it on an hourly basis exposes 38,410, followed by 38,140 next. So just a quick recap, bearing in mind that since the swing low of 27th of September last year, the Nikkei 225 or the Japan 225 has been trading in a very multi-month sideways complex range for the last 4 to 6 months or so. Over here, only an hourly close and a push up above today's pivotal resistance level at 39,310 will invalidate today's intraday bearish bias to see a squeeze up floating up to the upper limit of this complex sideways range, with the next resistance zone to take note of will be at 39,710 830 above it sees the upper limit of the complex sideways range coming in very closely at 40,360. So i.e., in a nutshell, given the bearish momentum that is being depicted on the hourly RSI and the bearish reaction of the 20-day and the 50-day moving average, we will flip to a intraday bearish bias on the Japan 225, i.e. representing the Nikkei 225 using 39,310 as my short-term pivotal resistance level. All right, so what's next on the European side of the story, which is the German 30 over here. So the German 30 also hit our resistance level yesterday, which is close to the gap up, the gap resistance level. And right now, the hourly RSI also has starts to shape a bearish reaction over here and starts to turn down below the 50 level mark as well. So given this bearish reaction or bearish momentum reading in the hourly RSI, we're not so aggressive to actually play that further mean reversion bound hitting up to the current all-time high at 21,820. So with that, we will continue to we will actually flip now into a intraday bearish bias using the upper limit of the gap resistance that take shape yesterday, 21,625. So that will be my short-term pivotal resistance level. All right, first support level to watch on a intraday basis will be this give me a minute, let me put it all in proper writing. 21,290. Okay, 21,290. A breakdown below 21,290 exposes 21,100 and potentially even 20,940, which is very close to the rising 20-day moving average. So upon hitting this level over here, do potentially look out for any signs of a bullish reversal candlestick for a potential inflection point or a bullish reversal point if such bullish candlestick takes shape, given that this is a rather key near-term support level zone to watch as well, given that it also corresponds to the upward sloping 20-day moving average. But given that right now it has still some more room to go, so we still will have a intraday bearish bias for now as we are speaking, using 21,625 as my short-term pivotal resistance level. Near-term support level to watch on an intraday basis will be 21,290 followed by 21,100, then thereafter 20,940. Only an hourly close above 21,625 will invalidate today's intraday bearish bias to see the continuation of the impulsive up move of its short and medium term uptrend phase, retesting 21,825 all-time high followed by the next Fibo extension level at 21,960/21,990. So that's for the German 30. All right, now turning our attention now will be the US Wall Street 30. So the US Wall Street 30 yesterday, we do have a bullish bias, and the bullish bias hit our resistance level before it did that retracement. So for today, we will still continue to maintain this intraday bullish bias given of that V-shaped recovery that is seen right exactly at the 20-day and the 50-day moving average support level. So we will be using a rather tight key short-term pivotal support for today. So this key pivotal support, if I do a Fibo retracement of yesterday recovery, that also corresponds to the golden ratio as well. Okay, and some minor congestion area over here graphically. All right, 44,095. So using 44,095 as my short-term pivotal support level right now, there's some form of support level has been taking shape given this long tail hourly impending bullish hammer candlestick that it has starts to form as we are speaking. So 44,095 short-term pivotal support level on the US Wall Street 30, maintaining that intraday bullish bias from yesterday, a breakout above the first resistance level at 44,670 that it halted yesterday, managed to potentially may see a retest at the current all-time high area level at 45,090/45,100. All right, for today. However, if we start to see a breakdown below 44,095, then potentially we could see a retest again at the 20-day and the 50-day moving average at 43,730/600. Only a breakdown below 43,600 may open up scope for a minor corrective decline scenario unfolding in the first step towards the next near-term support level at 43,095 next. Right, so i.e. still maintaining that intraday bullish bias on the US Wall Street 30, but with a tightened key short-term pivotal support level at 44,095 for today. Right, lastly will be the Nasdaq 100. So over here, the Nasdaq 100 over here continues to actually plunge over here. there's a bearish reaction of the gap resistance yesterday as well. So yesterday what we did over here is that we do have a bullish bias to play that mean reversion bounce, and the bounce hit our resistance level, and now it reintegrate back below the 20 and the 50-day moving average, representing weakness as well, whereas the Dow Jones Industrial Average is still managed to hold above the 20-day and a 50-day moving average. A quick recap over here. So there's a different configuration now. US Wall Street much more bullish because it managed to shape that V-shaped recovery at the 50-day and the 20-day moving average, whereas for the Nasdaq 100, it's not so rosier. It has a bearish reaction and reintegrated back below the 20-day and the 50-day moving average. But because of this bearish reaction of these two key moving averages, for today we will flip to a intraday bearish bias. First resistance level to watch will be yesterday's resistance level that got hit, 21,450, but I'm not put it so tight. I put it slightly higher at 21,610, a kind of a clear graphical congestion area here. If you do the Fibo retracement of that previous sell-off from last Friday up to yesterday Monday's Asia session low, that also correspond to the 76.1 Fibo retracement, and as well as the pullback resistance of this former minor ascending trend line linking the former lows of 28th of January. So with that, using 21,610 as my short-term pivotal resistance level on the Nasdaq 100, we will flip to a intraday bearish bias for today. First support level to watch on the intraday basis, 21,125, that got tested right now as we're speaking. A breakdown below it exposes yesterday's Asia session low, 20,870. Below it sees the key minor swing low area that managed to help since 15th of January at 20,690. Only an hourly close above 21,610 and a push up above it invalidate today's intraday bearish bias to see a squeeze up towards 21,845/945 and potentially even retesting the current all-time high that was seen on December last year at 22,135. So i.e. using 21,610 as my short-term pivotal resistance on the Nasdaq 100, we will flip to a intraday bearish bias for today. All right, so that's for the conclusion, and it sum up today's coverage of the intraday technical outlook for the major stock indices. Now, turning our attention now next will be the commodities market. For sure, starting with the all-time, we call it highly focused gold XAU/USD. So for gold XAU/USD continues to rally as expected and almost hit our next resistance level, which is the next all-time high area, driven calculated by Fibo extension level, and as well graphically also the upper limit of this minor ascending channel that is in place or in shape since 31st of December last year at 2840 resistance level. So with that, I will have a rather tight pivotal support level for today at 2,795. So as long as any dip didn't surpass below 2,795, we will maintain our intraday bullish bias on gold XAU/USD above 2,838, 2,840 exposes the next near-term resistance to come in at 2,860, which is the one-time Fibo extension level. Above it says 2,883/2,890, which is also confluenced by a Fibo extension level as well from a different degree. So however, if price action starts to break down below 2,795, then that will negate today's intraday bullish bias to see it sliding down towards to retest yesterday's minor swing low area at 2,771, which also correspond to the so-called lower limit of this minor ascending channel. So once it hit the 2,771, do look out for any signs of a bullish reversal candlestick. If a bullish reversal candlestick take form, the bullish momentum may resume as well. But however, if you have an hourly close below 2,771, then that will actually trigger a minor mean reversion corrective decline sequence to unfold, exposing the next near-term support level at 2,745 and potentially even 2,728/2,719, which is confluence with the rising 20-day moving average. So i.e. In summary, we will be still maintaining that intraday bullish bias on gold XAU/USD, but using a tighter short-term pivotal support for today at 2,795. Right, 2,795. So with that, let us now lastly turn our attention to West Texas crude oil. So we know that on the daily chart, it starts to shape that bearish engulfing candle, and this bearish engulfing candle formed right exactly below the 20-day and the 200-day moving average. So despite the fact now it's holding above the 50-day moving average, and the hourly RSI also has starts to break down from a parallel ascending trend line support level, as you could see over here. this 20-day moving average, there's a high chance that it may not hold, and it may potentially slide further. And given the daily chart is a higher time frame, and in terms of technical analysis, we call it trading, higher time frame elements tends to take much more importance than lower time frame elements over here. So with that bearish higher time frame element as seen on the daily chart, we will actually flip to a intraday bearish bias for today on the West Texas crude oil. Continues to maintain the intraday bearish bias. So yesterday we have a bearish bias. The bearish bias hit exactly at the resistance zone, and it shaped that bearish reaction. So with that, right now it's breaking below the 72.70 level. So for today, we'll be using a rather tight short-term pivotal resistance level, 74.15 as my short-term pivotal resistance level. As long as 74.15 holds and not surpassed to the upside, we will maintain that intraday bearish bias on West Texas oil. Next near-term support level to watch after 72.70 will be 71.05. Very clearly a clear congestion area here. A breakdown below 71.05 for today potentially exposes the next near-term support level, which is this minor swing low area here of 27th of December. All right, 27th December at 69.78. Okay, let me put it in writing. 69.78. Right, 69.78 over here. Only a push up and an hourly close above 74.15 will negate today's intraday bearish bias to see it doing a churning up to retest this key resistance zone over here on the minor key resistance zone, which is the 20-day moving average acting as a resistance at 75.75 slash 76.16. Only an hourly close above 76.16 potentially trigger a mean reversion rebound scenario, exposing the next near-term resistance level at 77.40, followed by 78.90 next, i.e. in a nutshell, still maintaining that intraday bearish bias on West Texas oil, given the much more bearish element on the higher time frame chart, which is the daily chart that I explained to you earlier, but using a tightened key short-term pivotal resistance level today, 74.15 to maintain that intraday bearish bias on West Texas oil. So with that, that sum up the intraday technical outlook on the broad-based cross asset classes. So before we go, let's take a quick look at the economic calendar. What are the data to look out for today? So in terms of economic calendar, today will be Tuesday. So over at Tuesday will be a rather quiet session in terms of the European session as well. So not much on, okay, let me do a quick, yeah, correct. So not much happening during the European session open over here, rather quiet. All right. So what we could see over here is that we have some second tier US labor data. We call it the job opening, but definitely for sure this Friday are much more important data, which is the NFP and the unemployment rate. So this is a second tier US economic data. Jobs opening will be out at 11 p.m. Singapore time over here. And thereafter at 12 a.m. We do have two key Federal Reserve officials speaking, Fed Bostic, and later thereafter, pardon me, at 3 a.m. Singapore time, Fed daily speech. So market participants will be listening to their speeches, especially given the ongoing trade tension between US and its major trading partners. So how does it potentially shape US Federal Reserve monetary policy? And thereafter, more pertaining to the Kiwi dollar and the Kiwi crosses. Early morning Singapore time on Wednesday at 5:45 a.m. We do have the unemployment change and the unemployment rate for Q4 last year in New Zealand. So that could potentially impact the Kiwi dollar and the Kiwi crosses as well. All right. And what we could see over here is, yep, that is the key economic data to look out for. And for sure, the ever fluid potential trade tension between US and the rest of the world. So that is still ongoing. So they do keep a lookout on that based on if you're able to have any potential Bloomberg live feed news, they could actually start to see this. And for those who don't have any Bloomberg live feed news, there's this particular website, not really that live, called Forex Live. So they tend to update also key macro data as well. So this is free. So something that you could actually take a look out as well to monitor this ongoing trade tension news flow between US and its major trading partner. Yeah, one more thing before we go is we know that US is still on a brink of this key earnings season. So for today, there's another key data to actually look out for, key news, key earnings data to take note of, more more related to the Nasdaq 100 because of its relation with the AI optimism team play that has taken shape in the last 2 years. Alphabet, we know that for sure is one of the mega cap technology stocks, will report its Q4 earnings at the close of the US session today. That means i.e. at around 5 a.m. Singapore time, slightly above that. Then also we have AMD as well. So AMD is considered as the second tiers GPU semiconductor right below NVIDIA. So that will also potentially impact Nasdaq 100 movement as well. AMD will report its earnings Q4 last year Q4 earnings also after the close of the US session. That means right after 5 a.m. Singapore time tomorrow. Okay, so do take note of these two key earnings announcement from US that could potentially impact the Nasdaq 100 movement during the start of Asia session tomorrow. All right, so with that, that sum up today's daily dose of market insights. I'm Kelvin here again. So I wish you all a great day ahead and we shall speak again tomorrow. Thank you.